So without further ado, I'm going to kick off. And what I want to get out of this panel is a sense of what lessons can be learned from other industries. And particularly, I want to focus a little bit on experience with the e-invoices, because actually a couple of you guys are here. And look at how we can, what we can learn from there, what the key technology lessons are. And if I was a platform here thinking about trying to go for the public markets, what have I got to think about? Maybe you can help out that, Rob. And then lastly, try and take some points, George, a bit about what lessons should we have learned from the technology bubble of the 1990s, how we're going to survive any fallout that's bound to happen. Now, we had in that film, you know, not every company is going to make it through. So let me kick off first with Eddie. You've got a Tungsten, which is a quoted company on the London stock market. And you're attacking the whole kind of e-invoicing space. Now, I suppose the key idea I want to get across here is that none of this stuff is new, really, because people have been factoring businesses, e-invoicing businesses, people have been making loans for years. How is it that you use technology to suddenly get everybody from doing an old-fashioned way of passing a paper invoice through and sending it along and getting it paid? How would you transform that into something that can create this huge value?
Thank you very much indeed. This is my third financial disruption business. The first was leveraged loans back in 2000, formed the first billion euro CLO, and we all know what happened to that market. Yeah. But I'm delighted to say I sold out in 2004. So one lesson is sell before it's too late. The second business was Pension Insurance Corporation. Interesting lessons from that. Think big. £1 billion of startup capital. It's now got £14 billion of assets on its balance sheet. So
and that goes to big pension funds and takes their liabilities off them.
Exactly right. Now, what was the lesson from that? Was when we started up, there were lots of other people trying to kind of get around the regulations. And this is, I think, a lesson for this industry, which is, you know, there were people doing longevity risk arbitrage businesses, frightfully clever, based in Bermuda or something. But as soon as it became remotely important to the economy, boom, the regulators came in and they basically closed down anything that wasn't a fully regulated insurance company. And I would say this, wouldn't I? Why did I go through the pain last year of having my inside leg measured in several directions by the Bank of England to get a banking license? And go through the same pain in Germany and in France and in Italy? Is because we think that in the fullness of time, if you're not a bank, you're not in this game.
Very interesting. So we shouldn't necessarily regard this as banks versus the alternative finance sector. In fact, it's very cooperative, and in fact, you might even buy a bank.
Well, we did buy a bank, and we are a bank, and therefore I would say this, wouldn't I? But I think those people that are not banks are going to rapidly discover that as soon as investors lose money on your platform, as soon as there's a big fraud, and let's be honest about it, you know, Citibank lost $800 million to a single invoice fraud in Mexico last year. Fraud happens in this industry. As soon as there's a big fraud, as soon as your investors lose money, you know, the regulators will come down on you like a ton of bricks, and the whole industry will then go through a sea change of regulation.
Yes, sir. I mean, again, what's your perspective on this? I mean, what are the kind of key financial disruptor lessons? Again, because Basware is in this space as well, in the e-invoicing space, and remarkable growth in your market cap in the last few years. I mean, what lessons would you take away?
Well, we have started the business for automating the processes first in enterprises, and then we learned the payment behavior between the buyers and suppliers, and then we realized that there's a big opportunity. Third lesson was that most of the information flow between the businesses are still on the paper or unstructured data, which then actually makes everything happening very slow and it's very expensive. And then we found out that there's a great opportunity to make it streamlined, making electronic end-to-end, and that gives an opportunity. We do know who is the buyer, we do know who is the supplier, we do know what has been ordered, we do know what has been delivered, we do know what has been invoiced, and we even know is the invoice approved or not. And that's the information we can offer to the financial services institutions and the lenders. And that makes the situation much more efficient than ever before.
I want to bring in Eddie on this one as well. One of the key themes is the disruptors come along and then they basically say, we've got this amazing model that changes everything, we're going to scale up. And then as they scale up, they lose track of relationship management. They lose track of the client. You know, it becomes a giant scale operation, and you know that arguably, I suppose, what's happened with the banks actually. Arguably, they've become huge, and they've sort of lost track of that. How important is it as disruptors grow and metasize to keep control of that relationship management? Because effectively, there is a temptation to go, I'll just run it on a platform, and I don't really care. Well, I mean, interested both your perspectives on that. Esther first.
Well, we do know very well, actually. We are sitting on top of the gold mine. We do know a lot about the buyers and suppliers and their behaviors. That's the information we are able to use and offer that available for this financing decision. And then the risk profiling can be done automatically, and the situation becomes much better. And in your video, you were talking about the risk. So we are able to manage the risk better because you are not financing the company, you're financing invoices, which is different ball game from now on. So that I think that there are more opportunities, and it opens the new financing opportunities for the businesses.
So you're very much back at the point that it's get rapid scale, get volume, get big data, understand the client that way.
Exactly. So we have a good knowledge of the customers and their behavior, and that information is very valuable.
Eddie.
I've always had a little philosophy, it's people, not paper. And I suppose these days I call it people, not data. And we have about 168 multinationals, governments as our buyer customers, and thousands of suppliers. We have to understand the motivations of the people in those businesses. And they really don't honestly care whether our electronic invoicing capability does this or does that. What they do care about are things that matter to them, things like compliance. So it's not just about cost saving, it's actually really having a know your customer chain. It's being able to make sure you're not defrauded. And those are things that actually will terminate the career of the guy in procurement or the guy in finance in Unilever or Nestle. It's not saving $1 million here or there.
Very interesting.
And so we have to understand his motivation or her motivation.
This is fascinating because I think that it's true, I think in the alternative finance sector, there's been a real push to get origination, get businesses, for instance, in the SME sector through the door and I'm not just saying just lend, I mean, obviously it goes through risk criteria. But actually what you're saying is put yourself, empathize in the mind of the borrower, and particularly the person who's actually signing a piece of paper, think through what their risk structure is, how you look as a business, and actually, because there's an element of people just go, yeah, I'm just going to do compliance because I have to, yeah. But actually, you're saying is embrace that. Okay, very interesting. George, I want to just bring in you at this point. The opportunity sets in these scale data businesses is pretty obvious, but if it's pretty obvious to investors, because both of your shares have done really rather well, you know, if it's investors, it's obvious to the banks, isn't it? Because aren't the banks just going to go, well, this is very interesting. Hang on, we know a bit about this. And the reason I ask that is because you're from a telecoms background. You now invest in the alternative finance sector, so you can talk with both things. And in the telecom sector, all these amazing, sexy startups came up, and then they literally were obliterated by the traditional telecoms guys who came in and went, yeah, we'll have some of that, thank you very much. And wiped a lot of them out. And so a lot of the names we see now are just different names of the same AT&T and the same telecoms company that were around the last 50 years. Yeah. How is the industry going to survive when the banks wake up?
Well, I think one of the lessons that people have learned and have retained, David, is that there's a phase of excitement and then there's a phase of execution. Yeah. And I think when people shift from excitement to execution, a lot of other collateral effects happen. For example, what is celebrated as growth becomes celebrated as management. So all of a sudden, the individuals in a company that are moved to the front as the CEOs and as the COOs are the people that really can emphasize the execution and that capability, which means a very buttoned-down industry. And I think that that's what I see happening here. The companies that are going to succeed are the ones that can shift from the growth and excitement phase that we've been in, quite frankly, to the execution phase, and that can embrace change and not just be disruptors, but also embrace the necessary parts of the traditional system, like some degree of responsible regulation, for example.
So how does that practically mean? Does that mean you just employ a very smart CEO who can impress the investors? It means more than that, doesn't it?
Yeah, it means a tremendous amount more than that, because managing a startup fintech business is very different than trying to manage Citibank, for example, right? So it's a totally different type of institution, and I like to put adjectives in front of this bank. For, you can have, non-bank banks, you can have shadow banks, you can have non-profit banks. That's what, that's what these like credit unions are, because they don't run themselves for profit. They run themselves with a collective, right? So you've got all these adjectives in front of the word bank. And I think that is the way people can help to understand what this sector really is evolving into. Because I totally agree, the ones that are going to do well are the ones that now button down a little bit, not just grow like crazy.
Rob, you were nodding away then. You invested some of the most successful platforms in this space. I mean, is it really now just about a scale business? Is it about the quality of the leadership? Is it about the strategy? About all of them, I suspect, isn't it?
I wish I knew the answer. So I'm not sure we are invested. Well, we're invested in Zopa to a small degree. We're investors in Wonga. We're investors in another one we haven't yet announced in the true peer-to-peer space, and also Crowdcube and equity crowdfunding.
I think that gives you a bit of a knowledge.
So we'll see. Back in the day, we were invested in Betfair, which is not this kind of industry, but similar ideas,
model,
right? Sort of peer-to-peer approach to gambling. What does it come down to? I think you need, for really sustainable businesses, you either need proprietary data or you need really strong, genuine network effects. And that's what I think we look at in this market, is do you have a genuine data source, such as you have all of your suppliers' invoices and you have data that no one else had in the past, and you can use that for better decisions. Or you have a genuine peer-to-peer marketplace where people can get funded in minutes rather than days on other marketplaces. That was the secret to Betfair, was a genuine liquidity in that platform in a time-sensitive market. We look around, and I think there's a lot of people who don't have either of those, who are just sort of trying to scale on execution, and I think that has a limit to it in terms of how far you can take that. I think there is also that combination, particularly in consumer businesses, of just the growth and the scale and the buzz that you have around the business that can carry you through some of the regulatory hurdles. So you look at, for example, Airbnb or Uber that have tread on a lot of regulatory toes and got a lot of trouble with governments, but have been fast growing enough, and their customers love them enough that consumers love them, and consumers vote, and voters influence regulation. And they've been able to sort of get through that.
But isn't there also concern that also the thing about technology disruptors and financial services technology disruptors is that as they become an enormous scale, as they pump the scale through, they end up commoditizing their product. And we saw that with the telecoms revolution. Literally, people were leasing out, bits of transatlantic fiber for Zippo. And it effectively just commoditizes itself away so quickly to zero, and in fact we all benefit from it, the commonwealth of consumers and businesses that buy your services. But actually, you scale and commoditize, and you add on overheads to describe what you're doing, and effectively your profit margins just go.
And the good thing, the difference with telecoms is not the massive infrastructure costs here, right?
Yeah.
So you avoid that issue of kind of big fixed costs and low variable costs.
Yeah.
I think it comes down to it's sustainable advantage. So are you lending out multiple times to the same person, and you're learning a lot about their credit history that other people don't know? That gives you a real advantage. Or you're making long-term commitments and you've got people locked in, and you can take advantage of that.
I think one of the other questions is going to be, how long do we stay in the disruptive phase? And when does disruption become mainstream?
Yes.
And when it becomes mainstream, what happens to the valuation?
Yes.
Does the valuation become commoditized and down?
Yes.
Or does the fundamentals, does the efficiency of the sector allow for greater profitability, and therefore traditional multiples result in highly valued businesses because they're just so efficient and profitable? And that's going to be interesting to see which way that goes.
And in fact, that's a brilliant segue into, because I was going to ask you, Eddie, because I mean, so you must be looking at, say, Lending Club, for instance, with, I don't know if it's still 9 billion, but it's pretty not far off that number, 9 billion. And when you look at your valuation, which I've done pretty well, but not 9 billion. Do you sometimes wonder that actually, as your business grows and grows, that you maybe deserve a higher multiple, but then you look at your competitors, I suppose, that's where they go, well, actually, we might, two of you might push the margins down such that you don't deserve that big valuation. Do you see when I've got a couple of questions lurking in there? I apologise.
I think George makes a very good point. And I think from the origination channels in terms of electronic invoicing, that is where the commoditization is already occurring.
Yeah.
Even before it's got their real scale, it's already occurring. We had estimated about $1 trillion a year is now done electronically. It depends how you define electronically. And we're seeing the marginal cost of that electronic invoice going down to not a lot to deliver and to receive. So we're assuming that actually origination will be commoditized. We're going to still have to invest something like £100 million in making sure that we've got global reach. Can you imagine the joys of getting Indian tax authorities to actually sign you off in 27 states? We're doing all that. We're spending all that money.
And that has a barrier. It's a barrier.
So that then creates a barrier of entry.
Yeah.
One, we want to be global, really, truly global. And we want to capture the entirety of the flow of the world's largest Fortune 500 companies. Once we've got that flow, however, and we're prepared to accept commoditization to get that flow, then we can monetize it through lending, through data analytics. So that's the business model. Now, in terms of, do I look with green eyes at the lending? Yeah, so of course I do. Particularly as more than half our business is in North America.
Yeah.
Guess where I think I should go and spend next year? And it's not in London. And so, and having spent 25 years in private equity, kind of don't tempt me, But it's always an interesting arbitrage.
Essa, again, would it become to such a point where actually you give away the technology, you give away all the processing, and in fact, if you just say, we'll make the money on our turn?
Well, I think that there are many years to go before we are in that position, because still, unfortunately, in this country and most of the other countries, the processes in the businesses are so manual that there are huge improvements. So we don't have to be worried about the kind of price decreases for many, many years. Because in our case, we are able to improve the processes tenfold compared to what they are at current. Okay. So that there are plenty of opportunities. And then it may well be that think about the mobility, so that how it started and how many years it took before we are mature markets and saturated. And then people said that ARPU goes down, and it has not gone down, so that they have invented new services and they are earning more and more. And I'm quite sure that same is going to happen for our industry as well. So we are in early stages. We need to invest now for the reach, as he said, and we are our value of the invoices which did go through our network 2013 was $500 billion, and we are growing more than 30% at the moment per annum speed on that, and this is just the early stages. So the market penetration for electronic invoicing is still less than 20%. Okay. So that I think that the accelerated growth has not even started. And then when I think about your checks and everything else, so that how slow processes there are everywhere in the world, so that there are a lot of room to improve. So that I think that we have a great future. One last question
to Rob and George. How long do you think we're still in the disruption phase before we head into the scaling up bit, rather than worrying about commoditization, but actually just scaling in the alternative finance sector? What would your sense be? Are we still 1, 2, 3, 4, 5, 10, 15 years?
It varies hugely by subsector.
Yeah.
I think sort of peer-to-small business lending or peer-to-peer lending is becoming more mature, still plenty of room.
Yeah.
Everything else is pretty early, I think.
Pretty early.
But yeah, who knows how long this kind of current sort of surge of enthusiasm will last, right? I think 2050 may well be the kind of the top of the kind of valuation and investment kind of sphere in terms of this broader industry.
So get your IPOs in now.
Get the IPOs in now, absolutely, yeah.
George, what's your sense?
My sense is that we're going to have a couple of cycles. I think we're going to have the cycle where the first few come out, then there's going to be there will be some issues, there'll be a fraud, there'll be some things, there'll be some but then it's going to come back and it'll cycle back again. So I don't see it as a straight line, David. I don't see it as 3 years, 5 years, we're done. Yeah. I see it as we'll have these surges of innovation, and that's going to cause the follow-on disruption effect. I also think, though, that the comment that was made is absolutely true, that all this disruption is such a small, tiny piece of the global financial scale.
Exactly.
That, I think this is going to be this whole disruption, innovation, and change is a 20, 30-year cycle. I don't think it's I think we'll see these 2-3 year surges, but I think we're in a long-term cycle of change that is probably at least 20, 25 years.
Sorry, just one more question, Eddie.
Can I really disagree with that? I mean, I think this is a very fast-track moment that actually in the next 2 to 3 years, you'll see the major corporates, the major governments in particular, say everything has to be electronic. And as soon as everything has to be electronic, boom, you get a quantum shift. That's happening in the EU.
You think it's quite quick?
It's going to happen really quickly. Secondly, I've got bad news, is that actually a lot of those governments are demanding that you give it for free to suppliers.
Yeah.
And over 80% of our suppliers are today transacting for free over Tungsten Network. So you might like to think, it's complex and difficult. Too bad. We've got to invest that money to get that growth, to get that global flow, and we're not being paid for it. And, Esther's going to discover he's not going to get paid for it either. And that's just the way the market's going to go. It's going to change extremely rapidly, and we've got to be ready for it.
Esther, just one last thing.
Yeah, well, my country, where I'm coming from, we invented the mobility, and it took some 5 to 7 years when the height growth started. So that I agree with Eddie on this one. So that's it's something like 5 years. When we reached the penetration of 20% on electronic invoicing, which means that then the information flow is end-to-end electronic and structured, then actually it starts to happen very quickly. And I'm sure that the financing opportunities arise differently than they do arise today.
Well, that's absolutely fascinating. And the model of our day is that we're going to ask these gentlemen to go next door to the sugar room. And if you want to basically ask any more questions and find out a little bit more, my colleague Ryan will also be taking the text questions and we'll be interrogating you all a little bit more about some of the issues. But in the meantime, could you put your hands together and say thank you very much to our first panel. Thank you very much. Thank you very much.